and a lawyer, and he is in charge of our tax research.
Hi, everybody.
I know your time is valuable. We're gonna try to keep this as brief as humanly possible, hitting all of the important areas to give you enough information so you can start to make decisions as what would be best for you and your organizations to do. Again, we have a disclaimer. This is a very broad conversation. Obviously, you should talk to an advisor before acting upon any of the information in here, because we are not going into all the specifics of every program. Programs which might seem very beneficial to you, you might not actually be able to participate in. And similarly, your particular tax situation may cause something that seems less advisable to become more advantageous for you. So again, this is going to be so again, this is a very broad conversation. So what we're here to talk about is the Coronavirus Aid, Relief, and Economic Securities Act, or the CARES Act. It was passed unanimously by the Senate on March 25th. President Trump and the House moved it forward on March 27th when it was signed into law. The CARES Act, first and foremost, was intended to assist our hospitals and our first responders with this unprecedented pandemic that the country is undergoing right now. It puts a lot of money directly into the hospital system, expands the funding for testing and development of new tests. But what's more pertinent to us is this enormous economic relief package. The size of the package of economic relief is a little bit less than $2 trillion. One way to look at that is over $5,000 for every human being living in the United States. It includes individual rebates, expanded loans for small businesses, increased unemployment benefits, tax breaks to a variety of different industries. And similarly, the states have begun to act as well. Each of the state is obviously acting based upon whatever their abilities are. They have less resources at their disposal than the federal government, and therefore their relief is substantially less than what we're getting from the federal government. But again, a $2 trillion relief package, that's more than double the annual budget of the United States. I mean, it's a staggering sum of money. So the first thing that we're going to go into right now are some of the tax provisions. This will be led by Cathy Davis. So Cathy, if you're ready.
Absolutely. Thanks, Michael. And thanks everybody for joining us. I'm going to start off with a little bit about the individual stimulus payments. The IRS is set to issue payments to individuals in the amounts of up to $1,200 for singles, $2,400 if you're married filing jointly, plus $500 for each qualifying child under the age of 17 or qualifying relative claimed as a dependent. The amount that you receive is based on your 2019 return, or if you haven't filed your 2019 return, it'll be based on your 2018 return or your Social Security benefits statement. And they are an advance against a newly established 2020 refundable credit. The stimulus payments are not taxable to the recipient. So for singles, the payment is going to be reduced for income levels over $75,000, and it's entirely phased out when your adjusted gross income goes over $99,000. Married filing jointly, the phase out begins at $150,000, and it's eliminated for adjusted gross incomes over $198,000. So as far as how people are asking, how are we going to get these checks, or how are we going to get these payments? The IRS should start issuing them within the next two to 3 weeks. If your last federal tax return included banking information, the IRS is going to directly deposit the stimulus payment to that account. Additionally, the Treasury Department is going to be setting up a portal where you can enter the information sometime in the next few weeks. And in the absence of all banking information, the IRS will just issue a paper check.
Cathy, one of the things we talked about before is a number of reports of people calling individuals claiming to be the IRS and asking for banking information. And the IRS will never call anybody at home. They will never call you and ask you for your banking information. Any calls anyone receives like that is a scam.
Yep, never, never, never. It's not going to happen. So don't answer any questions like that over the phone.
Right. And one other thing I would like to say to anybody who's listening in, if you have any questions that you would like the panel to address, there should be a box available to you in the Zoom window that has question and answer. Please feel free to type in any questions you want, and we will filter those up to the people presenting.
So I see a question about filing 2019 tax return, if there's a significant increase in AGI over the 2018 AGI. You know, the adjustment's all going to shake out in 2020 no matter what. So, you know, your 2020 adjustment will be based on ultimately your 2019 income, if that makes any sense. So I hope that answered your question. I think that was John. Okay, so we're on to the next slide. To encourage employee retention during this economic downturn, the Act allows for deferral of the employer's share of the 6.2% Social Security tax, which is the FICA portion that would otherwise be due. So the deferral period starts on the CARE Act's date of enactment, which was March 27th, and it goes through December 31st, 2020. And the taxes that would otherwise have been due may be paid half on December 31st, 2021, and the other half on December 31st, 2022. Under the CARES Act, eligible employers can choose to get an immediate credit from the new employee retention credit, which is refundable. And Len's going to discuss this in more detail shortly. The payroll tax deferral is not available to any business that takes out a loan under the Paycheck Protection Program, which is in turn forgiven. And Len's also going to get into this shortly. So net operating losses and business losses. The Tax Cuts and Jobs Act of 2017 put in some limitations on net operating loss deductions. The CARES Act has amended those provisions and essentially deferred the effective date of those NOL limitations for 3 years. So as a result, NOLs that are earned in 2018, 19, and 20 will be permitted to offset up to 100% of taxable income, as opposed to the 80% limitation, which had been established by the TCJA. Losses from 2018, 19, and 20 can now be carried back for up to 5 years at the federal level to allow businesses to claim refunds of taxes in prior years. This creates a nice opportunity for recouping tax on business income that was assessed at higher pre-TCJA rates. Additionally, owners of pass-through entities are no longer subject to excess business loss limitations for 2018, 19, and 20. So for example, if you have an individual single taxpayer who had a 2018 net business loss in excess of $250,000, that taxpayer can file amended return to take advantage of pass-through losses and claim a refund. And that excess loss limitation was $500,000 for married filing jointly. The $250,000 is for singles.
Now, Cathy, we received a question over the wire about stimulus package elements that would be beneficial to companies that are in a pre-revenue state. Now, my understanding is one of the biggest elements that will be available to these entities would be the deferral of that 6.2% employer portion of Social Security to the extent that they have wages. That would be available to any company, whether or not they have revenues. And similarly, these NOL provisions would also be beneficial to those entities. They'd be able to apply these losses against prior business activity or other income. Is that accurate?
Absolutely, that is for pass-throughs. I mean, if it's a brand new entity like a corporation, then maybe not. But for pass-throughs, yeah. And you know, Len, I think Len's going to touch on that a little bit later when we start talking about the different business provisions that are put into the CARES Act. So, and back to the net operating losses and business loss changes as an aside, the states are not likely to strictly conform to the changes to the NOL and excess business loss rules if they conform at all. This will result in separate state NOLs, which will of course add another layer of complexity to applying the CARES Act provisions at the state level.
And Cathy, most people that are availing themselves of these new rules, they would have to file amended returns, even though I guess some of them could do this stuff prospectively based on their 2020 returns if they haven't, if they've already filed 2019.
Right. So, we'll have to discuss the cost benefit on a case-by-case basis with clients to determine the most advantageous path. Whether you want to go back and amend the returns, or do we want to file a change of accounting method in 2019 and claim the adjustment in that year. We'll have to see. Okay, so technical correction. The CARES Act brings some good news about the tax treatment of qualified improvement property. So what's qualified improvement property? Qualified improvement property is any improvement made to the interior portion of a non-residential building any time after the building was placed in service, with the exception that you exclude enlargements, structural improvements, things like elevators. When the TCJA was enacted, Congress's intent was to assign a 15-year life to qualified improvement property. That would have made it eligible for bonus depreciation, which had been increased to 100% for 2018. However, they failed to define this in the written legislation, so property that should have been allowed a one-year write-off had to be written off over up to 39 years. The error was referred to as the retail glitch and was finally addressed with the passage of the CARES Act. This long-anticipated technical correction is welcome news, in particular to restaurants and retailers, and is retroactive to January 1st, 2018. Taxpayers can file amended returns to claim the accelerated depreciation during 2018 and 2019 if those returns have already been filed. Any net operating loss generated in this way can be carried back 5 years to recover taxes previously paid. Alternately, taxpayers may choose to file an automatic accounting method change with their 2019 tax return to retroactively claim missed accelerated depreciation deductions. And in that case, the missed depreciation would just be claimed in the current year as the 2019 year as a favorable 481A adjustment. You want to go to the next slide, Jess?
Sorry, Kathy. I wanted to get a couple of questions that were in the portal. The first, there was a question about the stimulus payments. So the stimulus payments, would they be offset against tax liabilities? My understanding is they were coming straight out, but I don't know about whether there is an offset.
No, they're not going to offset tax liabilities, but it's a credit. So the credit could potentially be phased out depending on your actual 2019 income, but that won't be determined until your 2020 return, because the credit's really a 2020 credit. It's an advance payment on a 2020 credit. So you're not going to have to pay it back. In other words, if your income goes up, the credit could be, you're not going to have to pay it back, but the credit that you receive in 2020 would just be reduced to zero.
And there was another question here about the IRS portal. And just to be totally clear, we've been notified that this portal, which I believe will be done by the Treasury Department directly, will be coming out in the forthcoming week or week and a half. My understanding is that it will be advertised through, the general media. But if you do not access the portal yourself to put in your information as to where you want to receive that stimulus payment, they will generate a live check to whatever the last address on file is for the IRS.
Right. My understanding is that the direct deposits will come quicker than the checks. But I mean, it's, they said they were going to start issuing payments 3 weeks from March 27th. So soon. Okay, so some other items of note. There were some changes to charitable contributions. So in 2020, there's a new above the line deduction available for taxpayers who don't itemize. An up to $300 reduction in adjusted gross income can be taken for qualified charitable contributions. And the CARES Act also temporarily suspended the adjusted gross income limitation for qualifying cash contributions. Premature distributions from qualified retirement plans like a 401k made between now and 12/31/2020 will not be subject to the 10% penalty if the distribution is coronavirus related. Early distributions will still be subject to income tax, but the income can be recognized over a 3-year period beginning in 2020. Alternately, there's the option of repaying the distribution within 3 years, in which case there's no income to recognize and therefore no associated tax liability. And for those who wish to borrow from a qualified plan, you can now borrow up to $100,000 from your plan or the maximum dollar amount in your plan, whichever is lower, between now and September 23rd, 2020. After that, the maximum that can be borrowed reverts to the previous limitation of $50,000. And then just a quick note about the required minimum distributions. The CARES Act suspended the required minimum distributions from IRAs for 2020. So for retirees, that's good news because it postpones the tax effect on the distributions and increases potential for investment gains as the stock market recovers. Okay, and in other news, July 15th is the new April 15th this year. So any taxpayer with a federal income or gift tax return, payment of 2019 liability, and or payment of Q1 2020 estimated taxes that would normally be due on April 15th has an automatic extension to July 15th, 2020. The extension also applies to IRA contributions. Initially, the IRS had limited the amount of tax that could be deferred to $1 million for individuals and $10 million for businesses. That cap was subsequently removed, so there's now no limit on the amount of tax originally due on 4/15 that can be deferred to 7/15. The second quarter estimates are still due June 15th, 2020. Payroll and excise tax returns must be filed and paid on their original due date. So Len, I've had some questions about information returns and foreign returns. Would you like to address that quickly?
Sure. So let me just briefly note the problem. So with the IRS notice that specified all of these generous extensions, they said in the notice that it didn't apply to information returns. And of course, given the hurried state of things over the past few weeks, information returns were not defined. Now, traditionally, we might think of information returns as 1099s, various healthcare related forms, but for many taxpayers, for many of our clients, these information returns include forms 5471, 5472, and that whole family of forms, which relate to international information reporting. So companies or individuals that have various interests in foreign corporations, say, or domestic corporations that are at least partially owned by foreign individuals or corporations. So ostensibly, you would think that because those returns would be part of the tax return, that they too are extended. However, it's not clear. So those taxpayers that are affected by this, by the notice and its vague definition of information return, which is quite a few, they're in a bit of a limbo as to whether or not they should simply extend on April 15th or treat themselves as automatically extended through July. So the AICPA and perhaps other organizations have insisted that the IRS issue timely guidance clarifying that the relief is extended to, the deadline relief is extended to information returns, international information returns, specifically forms 5471, 5472, 8858, and the like. So that still is an open item, and that's something that I'm trying to keep an eye on. And the fact that these notices and updates are coming out every day. I mean, during this session with you, we may have some updates, but it's an important piece of news that a lot of our firm's clients and a lot of taxpayers are expecting.
Yeah, absolutely. And just a last note about the extensions. Some of the states have conformed to the deadlines. New York has conformed in its entirety, but others have conformed in part. New Jersey just announced like an hour or two ago that they're extending to the July 15th deadline, and our fiscal year has actually changed now to September 30th. The full details about the extent of New Jersey's conformity with the IRS deadlines have not been released, but we'll keep you all posted.
Cathy, there was a question about simplified employee pension plans and other types of retirement savings. Is that deadline also extended along with the IRA?
So, well, the SEP payments were always due by the extended due date of the tax return. So they would still be due in October.
Okay, so no effective change for them.
No.
Great. So Cathy, thank you so much for that. And now we're going to transition over to some of these aid packages for individuals and for small businesses. And Len will be leading our conversation on these items.
Great. So let me just formally say hello to everybody. And I appreciate your time. It's a pleasure to be with you despite the difficult circumstances. So we're going to try to power through several important programs enacted under the CARES Act. And let me just, as a threshold matter, say two things. One is that by no means, kind of dovetailing with what Michael had said earlier, by no means is this an exhaustive presentation. There were many, many programs enacted under the CARES Act. We regrettably cannot touch upon all of them. And concomitantly, there were many programs enacted under the Families First Coronavirus Relief Act about a week before the CARES Act was passed. And we are not really going to talk about any of the programs under that legislation either. However, we would be glad to discuss them with you on a case-by-case basis and address the specifics that you have absolutely at any time. The second point is that these programs, and again, given the quick nature of their development and their release, some were very well thought out, some perhaps a bit less so. There are a lot of holes left to plug with these programs. And so many of them are interrelated. Use of one precludes use of another or limits the use of another, and so forth. So these regulations are hotly anticipated. They're supposed to be out by next week. They may be out tonight. They may be out by the end of the week. It's not clear. There have been some snippets of information put out there by agencies and by Congress, but to the best of my knowledge, at least as of this morning, I haven't seen anything official yet, but hopefully those regulations that are released by the Department of Labor, by the IRS, by the SBA, will put pay to some of the questions that you have and that we have as advisors. So this is a bit of a work in progress for all of us. So as these regulations are promulgated, as more information becomes available, we'll certainly be advising you of the same, and we'll be available to provide information as timely as possible. So the first program we'll talk about briefly is the expanded unemployment assistance under the CARES Act. There's a bunch of acronyms for these programs and for others that we're talking about today. So the first is this Federal Pandemic Unemployment Compensation, FPUC. This is an additional $600 per week that is available only through July 31st, 2020 to all individuals receiving unemployment benefits. It's going to be paid weekly or consistently with the payment schedules that are in effect by the states paying their regular unemployment benefits. Once those benefits lapse, an additional 13 weeks of general benefits called Pandemic Emergency Unemployment Compensation, these will be available for 13 weeks. However, the recipients of this supplemental assistance must be searching for and able to work. As a parallel program, for those individuals who are generally not eligible for unemployment benefits, so those are the self-employed, the independent contractors, the gig economy workers, they get this PUA, Pandemic Unemployment Assistance, retroactive from January 27th, 2020 through December 31st. That's up to 39 weeks of unemployment assistance that matches the 26 weeks that are provided by the states, all except about 8, I believe, plus the 13 weeks of pandemic emergency unemployment compensation. However, these individuals have to self-certify as to their inability to work on account of COVID-19, or to care for a loved one on account of COVID-19 and so forth. So there is some perverse incentive here to go on unemployment because many of the folks who are sadly becoming unemployed or have already become so, they would be making more through unemployment assistance than they were in their previous jobs. So this is, I don't know if Congress considered this or if they just brushed it aside, but there is a disincentive to work with respect to some of these programs. And with respect to PUA, there is an incentive to perhaps bend the truth a bit in certifying inability to work on account of the virus. So this is just an interesting development associated with these generous programs. One other point is the short-term compensation. These are the programs that many states have where they encourage employers to temporarily furlough workers, but put them on a part-time schedule. And as a result, those workers could receive partial unemployment benefits instead of full ones. So state programs have received additional funding under the CARES Act as well.
Len, can you give any flavor as to the mechanism whereby people would avail themselves of, particularly the PUA, people that are either self-employed or gig workers? How would they enter into that program? How would enrollment physically take place?
Yeah, that's a good question. To the best of my knowledge, I'm not sure that anything has been promulgated specifically addressing how to sign up for PUA, but it must be coordinated with the state unemployment bureaus. So that information is either available online or shortly will become available. I'm not sure, Michael or Cathy, if you've seen anything to that effect, but I have not seen any specific guidance that says how one goes about securing PUA. For those who are interested, this is something we can definitely look into and keep you apprised of. So again, Cathy, Michael, I don't know if you've seen anything, but please let us know if you have.
I have not
Okay.
yet.
No, and there's another question about the FPUC.
Mm-hmm.
Is that available to people that are on partial unemployment benefits or only people that are on full unemployment?
My understanding is that it's available to everybody, that there's that there are no exceptions for who is eligible for FPUC.
And FPUC is administered by the states, even though it's federal money?
That's correct. Okay. All right, so let's move on to the retention credit. This is an important program that has a lot of these holes in it still that I had mentioned. So effectively here, any business that is forced to suspend or close its operations due to the coronavirus, but that continues to pay employees during the shutdown, may be entitled to a credit against its share of the Social Security tax, the 6.2% Social Security tax. Now, the eligibility is predicated on a disjunctive test. First eligibility point is if the business's operation was fully or partially suspended due to a government order on account of COVID-19, and that full or partial suspension resulted in a limitation of commerce, travel, or group meetings for the business. And alternatively, if the business remained open, but during any quarter in 2020, receipts were less than 50% of what they were for the same quarter in 2019. So I'm not sure which will be easier for which businesses, but it seems that number one is pretty broad. So I think a lot of businesses, even that have their employees working from home, could make a credible argument that their operations were at least partially suspended. So they would, as a threshold matter, qualify under the first prong of the test for this credit. So the credit is available for wages paid after March 12th, 2020 through the end of the year. And it's a quarterly credit available until the employer has a quarter where it's recovered sufficiently that its receipts exceed 80% of what they were for the same quarter in the previous year. So there's going to be some mathematics involved here, but this is an important limitation on the availability of the credit. Again, the credit is going to be 50% of the so-called qualified wages paid to each employee for that quarter, again, ending at the end of the year. Now, this is another significant point, is that these wages depend on, are tied with the size of the business. So if there were more than 100 employees in the business in 2019, then qualified wages refer to amounts paid to employees that are not providing services on account of the virus. And for those that have 100 or fewer employees, qualified wages refer to all wages paid. Okay. So what does this mean? So if you let's say run a trucking business that delivers food to grocery stores and to restaurants, and you have a group of truckers, again, this is highly simplified, but you have a group of truckers that deliver to grocery stores and another group that delivers to restaurants. Grocery stores don't need to close. In this state, perhaps Pennsylvania, New York as well, but restaurants and bars, if not closed, they have to suspend a lot of their food deliveries. So if you continue to pay wages to truckers who used to deliver food to restaurants but no longer do, and you have more than 100 employees in your business, only those wages paid to the truckers would be qualified wages for purposes of the credit. The other truckers' wages will not count, right? So if you fire those truckers, okay, and you're more than 100 employees, you're not going to get anything, okay? No credit. Whereas if you have fewer than 100 employees, the wages that you pay to the grocery store truck drivers and to the former restaurant and bar truck drivers, they will all qualify for purposes of the credit. Okay, so this is an important nuance associated with utilization of this credit. So qualified wages, typically in the nature of salary and similar compensation, but they do include health plan expenses, such as those spent to maintain a group health plan. But it looks like self-employed health insurance, like an S-Corp shareholders, would not count towards qualified wages. So that's an important distinction for the S corporations out there. And the amount itself for all quarters cannot exceed, for each employee, excuse me, for all quarters, cannot exceed $10,000. So this is I guess the overall limitation, where it's a 50% credit, but the amount of qualified wages cannot exceed $10,000. So essentially, it's a $5,000 credit per employee permitted, and the credit itself is based on wages paid under the rate earned in the 30 days immediately preceding your eligibility for the credit. An important point is that, an additional point, there's several of them here, as we can see, the credit is refundable if it exceeds the business's liability for payroll taxes. So you can use it to get a refund of payroll taxes not yet paid. Now, query how this is going to be reported on Forms 941. I'm not sure exactly how that's going to happen, but I do know that the IRS has released a draft form called the 7200 that looks to track advance utilization of the credit. So that's I guess, some help that the IRS is trying to provide quickly because employers will surely look to utilize this credit quickly. So keep an eye out for that form. Again, it's just in draft format now, but it is available. You can just perform a quick search and you'll find it. Another important restriction is that the wages taken into account in connection with this credit do not include those that you pay under the leave afforded to employees under the Coronavirus Relief Act. So again, that's separate legislation that provides credits to employers who pay folks who are taking medical leave on account of COVID-19. Those are not counted either for purposes of the credit. And perhaps the most important restriction, at least for this afternoon's discussion, if an employer takes out a loan under the Paycheck Protection Program, which we will discuss shortly, the credit is not available. The deferral that Cathy had mentioned earlier is available, okay? But the retention credit is not. So you kind of have a bit of an either-or proposition as to which program you utilize.
Len, can you give us a little flavor as to the meaning of the phrase fully or partially suspended due to government order? Would that be anyone in New York or New Jersey who's operating a business that was not deemed essential?
So that's a good question, Michael. I mean, so I can't give you, my interpretation would be just as valid as yours and those of our colleagues on the call. The regulations hopefully will add that flavor, but the statutory language simply speaks to full or partial suspension during the quarter due to orders from a governmental authority that limits commerce, travel, and group meetings for commercial or other purposes. Okay, again, I'm paraphrasing a bit, but that is the statutory language. So I think that I think it's pretty broad. So essential, non-essential, I mean, that dichotomy doesn't exist in the statutory language. It really refers to an eligible employer, which means any employer that has had this full or partial suspension. And I would argue under the fairly restrictive orders from the governors Cuomo and Wolf and Murphy in this tri-state area here, that many businesses will indeed, or should indeed, qualify for this credit. Okay, so let's move on to the Paycheck Protection Program, the PPP. Okay, so interestingly enough, there was recent informal guidance issued by the SBA about this program, and it looks like beginning April 3rd, which I think is Friday, small businesses can apply, and beginning April 10th, independent contractors and the self-employed can apply. Okay. So the program is just about open for business, although again, to the best of my knowledge, full-blown regulations have not been issued. Okay, so we're going to need to keep an eye on that, and if anyone sees the regulations being issued during the course of this webinar, please let me know. Save me a bit of time too. So let's talk about the program's details. Okay, so the purpose of the program is to provide short-term cash flow assistance to small businesses, to help them deal, of course, with the effects of the coronavirus. Now, the loan has to be necessary due to, quote, the uncertainty of current economic conditions. I would argue that that is fairly inclusive language too. I think that many businesses are facing uncertainty in the light of current economic conditions, and could make a very solid argument and certify to that effect that the loan is necessary because of that uncertainty. Now, the SBA administers the PPP, but it will effectuate this program and the associated payments through its certified lenders. Okay, these loans must be made prior to June 30th, 2020, and they are available to the traditional small business concern under the SBA rules, which has long been defined as, again, paraphrasing a bit, but independently owned and operated, for profit, not dominant in its field. It's also available to nonprofit organizations and effectively to a wide variety of employers with 500 or fewer employees, or more than that, but consistent with the applicable size standard in employees under rules promulgated by the SBA. We're not going to get into those weeds for now, but understand that there's some flexibility with the size standard. Now, all of these employers would need to certify to the adverse impact of the coronavirus and what they plan to do with the loan proceeds. Eligible businesses also include sole proprietors, independent contractors, and other self-employed individuals. So one important point of availability of PPP loans, franchises. So for these businesses, it's important to note that the 500 employee limit is per location. There's been some consternation about informal guidance released by the U.S. Senate Committee on Small Business and Entrepreneurship that has said that an entity is limited to one PPP loan and it's registered under a single TIN to prevent duplicate loans to the same entity. But what if you have, how does that square with the multiple locations and the number of employees at each location? So there have been industry letters that have already gone out to Congress and to the SBA, saying that this needs to be clarified, that there's not going to be that rigid an application of the one loan per taxpayer identification number rule, or that there's going to be some exception to that standard. So we have to, of course, keep an eye on that as well. The loans themselves, okay, these are limited to the lesser of the sum of average monthly payroll costs for the 1 year period ending on the day the loan is made, multiplied by 2.5. So that's a bit of a moving target, the day the loan is made. I'm not sure exactly why it's written like this, but it is what it is. So you would look at your payroll costs over the past year, each month total. Okay, you take the average, you multiply it by 2.5, and that is the loan that you would be entitled to get. Or if $10 million is the lesser amount, you would get $10 million, right? It's a lesser of test.
Len, when you're looking at the payroll cost, does this also include, I know you mentioned healthcare benefits. Would this include dental and vision benefits as well, or just traditional healthcare as the term is normally used in the U.S.?
You know, that's an interesting question. So I can't recall if it gets so granular as to saying that dental benefits are excluded from the calculation of payroll costs.
I'm sorry.
Yep.
The Small Business and Entrepreneurship Committee of the U.S. Senate put out a summary, and it says payments required for the provisions of group healthcare benefits, including insurance premiums. So no, I don't think it gets that granular.
Okay, right. So I mean, in the absence of an exclusion, I mean, I would argue that it's all included. But maybe that's aggressive under the circumstances, but I think everyone will be aggressive in determining what's included when determining the amount of their loan. But payroll costs in general include salaries, wages, commissions, leave payments, sick leave payments, so leave meaning vacation leave, family leave, sick leave, healthcare benefits, including premiums, retirement benefits, severance payments, payment of state and local tax assessed on employee compensation. Right, so it's a pretty encompassing definition. So again, in the absence of more definitive guidance that specifically excludes those kinds of premiums that you mentioned, Michael, I would lump them all in. Again, this is just my opinion, and it could very well change once we have maybe something a little more concrete. But for now, I think I would use them in the calculation. What payroll costs do not include, they don't include the compensation of any individual in excess of $100,000. They don't include federal payroll taxes. They don't include federal income tax withheld on wages. They don't include compensation of any employee whose principal place of residence is outside the U.S., nor do they include the wages of any individual who is getting paid by virtue of being on sick leave or family leave in connection with the employer receiving a credit under the Coronavirus Relief Act. So I think you all can see that there is just a host of rules associated with this program and other programs too, of course, but with this one in particular that tie together with utilization of other programs so people don't get double or triple benefits. So we have to be cognizant, both as employers and us as advisors, certainly, that to recognize the limitations that you may have in utilizing these programs to their fullest extent. So the loans themselves, okay, they can be used to pay for payroll costs. Payroll costs are the metric in determining the loan amount. But they can be used to pay for payroll costs as well as mortgage interest, rental payments, utilities, and interest on other debt incurred prior to the PPP loan being extended. The loans themselves, they have a maximum maturity of 10 years and an interest rate that is not to exceed 4%. No personal guarantees are required. The loan is non-recourse to the business owners if it's used for its intended purpose. And perhaps the most important provision is the forgiveness provision. So the principal amounts for the first 8-week period from when the loan is made, the so-called covered period, may be forgiven if used to fund payroll costs, interest payments on mortgages, rent, and utilities in place before February 15th, 2020. Now, an important point that the SBA made in its very early guidance, that the, first of all, two important points. One, they encourage people to apply as early as possible because there is a cap on the program, so the funds will run out. Okay, the funds will run out. The second point is that they anticipate, this is not binding statement or anything like that, but they anticipate that in order to obtain forgiveness, you're going to have to use 75% of the loan funds for payroll costs. So not for mortgage payments, not for rent, not for utilities, but for payroll costs. Okay, so if you are hoping to utilize it mostly for these other things, it may be difficult, at least if you may get the loan, absolutely, but it may be quite difficult to get forgiveness, okay? So again, forgiveness, the measuring period is 8 weeks after the loan is extended. To get the full benefit of loan forgiveness, a business has to keep its employees and pay them at least 75% of their prior year compensation. Again, you don't consider annualized salaries of more than $100,000 for purposes of this reduction. And concomitantly, you have to keep your average number of full-time employees the same based on one of two measuring periods, February 15th, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. And again, I know that some of this information is not contained in the deck you have, so if you have questions you'd like to see these details to be provided to you in an email or something along those lines, please contact one of us and we'd be happy to do that. But just
Len, if we can, if we could just pause for a second, there's a bunch of questions that I'd like to run through real quick.
Oh boy, okay. All right.
There were a couple questions related to compensation. I'm going to just roll back a slide. When we're talking about individual compensation, there were questions related to whether or not this included owner's draws or other payments that were made to, let's say, the owners of an S Corp or members of a LLC. Can you give a little more flavor on that?
So I don't know about draws, but I certainly the salary, the reasonable compensation that's paid to S Corp shareholders should count for purposes of a PPP loan. Again, I don't think, and maybe Cathy has seen something. She's clearly very, very on top of the latest guidance about whether these kinds of non-salary type payments, so not wages, not salaries, not commissions, not tips, whether draws would constitute payroll costs. I'm inclined to think the answer is no.
I agree with you. I mean, an owner draw distribution is an equity transaction. It's not an expense.
Okay, so there we go. A more concrete answer. So I'm inclined to agree. I think that the program is really designed to focus on the traditional payroll costs and not these equity type transactions. So that's again, there could be guidance that will be more generous, but at this juncture, I think that probably you can't consider those kinds of draws as payroll costs for purposes of the loan.
Now, Len, there's another question here about the 500 employee limit. Now, my understanding is that is across all locations unless you are a qualified company involved in either accommodations or food service.
That's my understanding too. Yep, that's my understanding too. And I would only just caveat that by saying that there are some industries in which you are permitted to have more employees, okay, and still be eligible for both the general SBA loans under Section 7A and the expanded loan program provided under the PPP. That is industry by industry. So if you feel that you may need to take advantage of that exception, we would need to review your industry and the associated NAICS code and see if that's covered by the SBA rules. So it's possible that you may still be able to take advantage of the program and have more than 500 employees. However, the expanded limit, the per location limit, is really for accommodation and food service businesses. I think that's right.
Now, there's a couple questions related to other types of payments for things that are very similar to payroll. The first would be 1099 payments made to outside sales representatives or contractors, or to temp agencies for workers that are working on site. My understanding is those are excluded from payroll costs.
Yeah.
What's your understanding?
Yeah, that's mine too. That's all. That's no more detail than that. I think is necessary. I think that's my understanding as well.
And for guaranteed payments, is your understanding those would be the same as owner's draws? Those are not necessarily income items?
Right.
I'm going to just run through these really quick. There was another question related to the application. Does the application for the PPP program, does that include a need for you to include detailed asset and liability information?
That's a great question. So the application is also out for the PPP program. So if you do a quick search, you will find the application. It is 2 pages. There are supplemental requests for information. And yes, you will need to provide various kinds of financial details along with previously filed returns, tax returns, and payroll information. But the application itself is very, very short, almost surprisingly so. I think that I guess, and perhaps not, that the SBA wants people to take advantage of this program quickly, and it doesn't necessarily want to bog them down in a morass of paperwork. So I guess that's understandable too. But if you simply do a search for the application, it just came out, I think late last night or early this morning. So you will be able to find it.
Very good. And there was another question here. This one's a little bit complicated, so forgive me.
Oh, wow.
So they want to know about independent contractors that are receiving qualifying income, such as commissions. Would that be determined to be a wage under these rules?
So I think the answer could be yes. So independent contractors are indeed eligible for loans under the PPP. And I would be surprised, since so many independent contractors are typically getting these kinds of payments. I mean, not the traditional wage payments, but they are, again, independent contractors, so they're not going to be getting salaries or wages. They're not employees subject to the control of their employer. I think that it would be in the nature of commission-type income, and that they should indeed apply for benefits under the PPP.
And the final question that's still open is about the leases. Are we talking about, you're able to use PPP for leases of real property, or able to use it for leases of equipment, or just for real property leases? So
I am fairly sure at this juncture that it's rental under a lease agreement is all the statute says. So I don't think it makes a distinction between equipment leases and office leases. I think the intent was to only reflect office leases, but I'm not certain on that. I don't know if Cathy has any additional insight on that point, but the statutory language only mentions rent under a lease agreement. So it's broad. So if you want to take a position that it covers equipment leases too, I don't think it would be unreasonable, because as far as I know, it hasn't been excluded. So again, Cathy, I don't know if you had any insight on that, but.
I mean, my opinion would be exactly what you just said. And maybe there will be additional guidance forthcoming. I'm sure that question will be asked.
Right.
So.
Okay. So the point I wanted to make briefly before we went into the stream of questions is about just a few simple examples about the reduction. So if you have 10 workers and you reduce it to 8 after you after you are extended a PPP loan, that's a 20% reduction. So if you have $100,000 and you want it forgiven, you're only going to get $80,000 forgiven. And if you, for example, reduce salaries by 30%, then you're going to be eligible for 70% of forgiveness. Okay, so you have to keep in mind that accepting the loan means, of course, accepting the various terms of the loan, which may be burdensome in connection with continued operations. All right, so next point here. The employers that previously had laid off workers, but who rehire those workers, they will not be penalized for having to reduce payroll at the beginning of the forgiveness period. And that is going to be measured from February 15th, 2020 through June 30th, 2020. So you'll want to take a look and make sure that if you do lay off people, that you hire them back. So as to take full advantage of the available forgiveness. And to apply for that forgiveness, okay, again, this is not automatic. So you're going to have to, at the end of the 8-week covered period, you're going to have to submit documentation regarding the eligible uses of the loan funds, the uses that you put them to. And you're going to have to certify that these documents that you're providing in support of forgiveness are true and correct, probably under some kind of penalties of perjury analog to what you often submit to the IRS, as well as the amount that you plan to request to be forgiven. So the SBA ultimately will purchase the loans forgiven from the lenders that forgive your loan. And as a final kind of cherry on top, the loan that is forgiven is not cancellation of indebtedness income. As many of you, if not all of you, likely know, the fact that a debt is forgiven is typically considered income to you, forgiveness of debt. Here, a loan forgiven under this program, the SBA is not going to submit any forms to the IRS saying that you need to be taxed on the loan amount forgiven. So that's really free money. So I think it's a very generous program, and Michael and I were discussing earlier how and in what fashion we'll pay for this down the road. But for now it's a very significant benefit. So for principal amounts that exist after the loan is forgiven under the PPP, the business can then defer any remaining principal, interest, and fees for 6 months and up to a year. Okay. And again, the loans themselves, okay, will be made by the SBA certified lenders, which are something like 800 institutions through authority delegated by the SBA. So the SBA has apparently already instructed banks to begin accepting and processing these applications as of April 3rd, and then April 10th for independent contractors and the self-employed. So again, guidance that's available is very limited. I see we might have some tricky questions out there that will probably be difficult to answer without looking into the statute more closely and then trying to parse any regulations that are promulgated. But again, the guidance is highly anticipated and hopefully will address some of the, at least the more common concerns that a lot of prospective applicants have. So
Len, let me just interrupt you for just 1 second. And there's a few questions in the queue, and I'm going to excuse ourselves from it. And one of them, James, I would say that your question is very, very technical, and I think it's an interesting question, but I don't know that we have an answer. And for Patricia, I'll just very quickly say that, that's a pretty heavy degree of calculus as to what would be best to do in your particular situation. You probably will need to model that out, particularly from your employee standpoint. But Richard has an interesting question I just want to bring up. And this is the question of companies that rely on a common paymaster, either a PEO or an outside company to staff their operations. How would those be computed for PPP purposes? If you're using a staffing company, a PEO company, it's really not the same as having a temp worker. I'm just wondering how those mechanically would work in terms of computing the maximum borrowing.
So that's a good question, and I don't have the answer to that, but I will say this: that from what I remember of the statute, okay, that the statute has directed that guidance be issued precisely on that point, on how the availability of the loan is going to be affected by utilization of professional employer organizations, certified professional employer organizations, agents, and the like. So I think that it's a great question, and I think that it's one that Congress punted on. I don't think that they had the time, the inclination, and perhaps the knowledge to go ahead and pursue it. So I think that that the answer to that is forthcoming. Again, unless I'll also always refer to Cathy, just in case she might have some additional insight. So.
Yeah, no, I don't have anything additional to add to that because I don't have any further information than you do at this point.
Right, Rich. Yeah, so Rich, I mean, we'll keep an eye on that issue, and I think some of our colleagues on the presentation are saying that there's been discussions with the SBA on precisely this point. So again, the regulatory guidance will hopefully address it. So in terms of action items, we had already touched on this briefly. I think that it's a good idea for for us to speak with you about your eligibility for this program, how we can maximize the associated benefit. But there's going to be some documentary burden on you and on your clients, for the advisors on this call, to assemble their payroll tax filings, to prepare their state income payroll and unemployment insurance filings, and to put together documents that verify their mortgage obligations, their leases, their utility payments, canceled checks, receipts, and so forth, just so you have all the arrows in your quiver necessary to timely put together an application and increase your chances of getting the loan. Again, there's going to be a queue, and I don't think it's that the Treasury, for no reason, put out that precatory statement about, hey, there's a cap on this program, and you're going to have to pay 75% of your payroll costs with the loans that you get. And so there's some concern about the demand for this program, and you want to make sure that you have everything ready to go when the time comes to apply, which will be this week, next week, and through June 30th, right? So not too much time in the larger scheme of things. And last, let's talk a bit about the disaster loan program. The disaster loan program. So the SBA has long made disaster loans. This is not new, but of course, like many existing benefits under provided by the SBA and by other organizations, the CARES Act has expanded access to those benefits. So most businesses, including sole proprietorships and small business concerns, and nonprofits, 500 or fewer employees, in this case, quote, suffering substantial economic injury. So they're unable to pay operating expenses, or they're unable to meet financial obligations, or they've suffered a reduction in working capital. Doesn't say to what extent, but that, again, so that's what it is, a reduction in working capital. As a result of the virus, and operating since January 31st, 2020, are eligible for these loans. Now, these are low interest loans, 3.75% cap, 2.75% for nonprofits, up to $2 million, maximum 30-year term, and available to pay for expenses that could have been met had the disaster not occurred. Okay? So they're available through the end of the year, but in contrast to the PPP, the personal guarantee component, personal guarantees may be required, especially if they're in excess of $200,000, and collateral may be required. And unlike the PPP, which looks to be a fairly routinized process, at least at this early juncture, the recipients of the applicants, for these disaster loans, they will be evaluated on a case-by-case basis. And the SBA will not just look to the applicant's need, but also their ability to pay the loan back, okay? Whereas, of course, with the PPP, your covered period loan in the 8 weeks after it's extended is going to be forgiven, okay? So it's a bit more onerous, a bit more stringent than the PPP program. Now, importantly, if you apply for a disaster loan, you can also apply for a PPP loan. There's no prohibition on applying for and getting both loans. But again, a bit ambiguously, the disaster loan that you receive cannot be used for the same purpose as the PPP loan. So if you use a disaster loan that you receive to cover your May payroll, the PPP loan that you receive, cannot be used to pay those same employees, though it could be used to pay different employees or for payroll in a different month. Okay, so you have to track the uses of your loan funds very closely, which is, again, an additional compliance burden imposed upon you as the recipient of these loans, and especially as the beneficiary of loans from both programs. One thing that the disaster loan does provide you is an emergency advance of $10,000, which is available within 3 days of applying for a disaster loan, okay? However, you have to request it specifically, and it does not need to be repaid. Does not need to be repaid, can be used for essentially any purpose. So I think that it's a good idea to absolutely shoot for both programs. Unlike PPP loans, which are applied for through the SBA certified lenders, Disaster loans are applied for on the SBA website. Their processing time is 2 to 3 weeks, first come, first served basis. Okay, so the SBA has not come out with any cautionary language about availability of disaster loans. That's one of the things that the SBA has always done. So maybe there's a bit more in the pot for these, but nonetheless, it's always prudent to try to get ahead and to apply for these loans as promptly as possible. So the applicants for these loans, they should prepare 3 years of business tax returns. They should also prepare the personal tax returns of owners of the business, 20% or more, in addition to general partners or managing members to the extent applicable of the business. They should also have their 2019 return ready or have an excuse that as to why the return has not been prepared. So you have to have a reason ready. And then there are certain SBA forms that need to be prepared. So specifically financial statements and debt schedules. And the applicant will also have to confirm if they have business interruption insurance. So it's a bit of an analysis, whether you qualify for both loans, which one to the exception of the other you're going to pursue, or whether you pursue both. If you have significant non-payroll costs, so costs that are not squarely fitting into the definition, the statutorily constrained definition under the PPP, you may want to pursue a disaster loan, especially the terms are more favorable, 30 years. I mean, there's no forgiveness, okay, but it's a 30-year loan. And if you expect to lay off employees, then a disaster loan is better for you too, because again, your forgiveness is going to be reduced by the number of employees that you lay off or the number of employees whose salaries you cut dramatically. So again, it's a bit of legwork involved before submitting the application, but I think for many it will make sense to apply for both, given the particularly broad purposes for which disaster loans can be used and the relatively reasonable terms, and the narrow purposes for which PPP loans can be used, relatively narrow, but more generous terms. So that's something that we can help you with, and we look forward to doing so. So, Michael, if you, I don't know if you want to make a few closing remarks, but for me, I think I've talked long enough. I think our colleagues are a bit tired of hearing me. So yeah. Perhaps you'd like to say a few things. So.
Never.
It's nice.
Thanks, Len. First of all, I want to apologize for us running a little bit over. And there are some people whose questions we weren't able to address during the webinar, and we apologize for that. But again, we're all available on our email addresses, as you can see from the last slide. Generally speaking, the MSPC offices in New York and New Jersey are not fully staffed due to the state of emergency going on in both locations. But we are monitoring email. We are all working remotely. We also have set up a general email account if you have questions based on the legislation and the coronavirus response, and that's cares@msbc-cpa.com. And again, people that are particularly interested in the SBA loans, may I recommend that you go to the SBA website for the EIDL loans. And if you were looking at a PPP loan, it might make sense for you to first contact whatever bank you already have a relationship with to determine if they are a preferred SBA partner. And if they are not, you can go to the SBA website or you can research your local banks. I will say that in this region, in the Mid-Atlantic region, the New York region, many, many, many banks participate. And it's highly probable that you have a relationship already with a bank that does. So again, everybody, thanks so much. Oh.
I'm sorry, can I just throw in there, we can help with that. We're gonna be setting up a help desk, and the link will be on our website in the coming days, but you can reach out to one of us and we can get you set up with somebody.
Right, we do have pre-existing relationship with bankers that are involved in this area, and we could make introductions for you if need be. But again, I would first ask who you're already dealing with, because there's a high probability that they will be able to help you. Again, everybody, thank you so much for your time. We do value the fact that you chose to spend your time with us. And we hope and pray that your families are well and that we'll get to see you all face to face in the upcoming months. Thank you.
Thanks,
Goodbye.
Amanda. Well, bye-bye.